Hello, everyone, and welcome to the July session of our ongoing webinar series. This one is called Investment Markets Live, a 2025 mid-year check-in. My name is Tom Bittinger. I'm with the content team here at Wealth Enhancement. And before we get started, I want to go over a few housekeeping items. One, there will be a Q&A session at the end, so feel free to submit questions using the questions pane, and we'll get to as many of those as we can. And as always, this session is being recorded. So if you have to step out for any reason, don't sweat it. We will send out a recording, so look for that in your inbox either tomorrow or check for it on YouTube. We've got a lot of other stuff on our YouTube channel there, so I'm going to continue to plug that until everyone subscribes. So we've got a lot to get into. As I said, we have a mid-year check-in, so we're talking about investment markets from January to now. So joining us is Jim Cahn, Chair of the Investment Committee and our Chief Strategy Officer. Jim, like I said, we've got a lot to get into, so I'm going to let you take it away.
Thanks, Tom, and thanks everyone for joining us. Today we've got a great panel to talk to you a little bit about what's going on in the economy and markets. There's certainly a lot going on. We have Doug Huber, Deputy Chief Investment Officer, Gary Quinzel, Vice President and Head of our Portfolio Consulting Group, and Aya Yoshioka, Portfolio Consulting Director and All-Star on the Portfolio Consulting team. So thank you everyone for joining us. Let's go to the next slide here. So if I told any of you that we were going to have tariff mayhem, that we were going to have a war in the Middle East, that we were going to have basically a bill that restructures the entire way that the government funds itself. It's a little dramatic, but that's kind of what we did. Would you have guessed that we would have seen equities at all-time highs? I will tell you that in talking to our clients and sitting through roundtable discussions and doing events with clients, I have never seen so much pessimism. And yet, buying and holding, keeping those stocks in your portfolio was yet again the right thing to do. And I think that that is really the surprise of the last 3 or 4 months. And that's what we're going to talk a little bit about today. Now, that said, even with benchmarks near their all-time high, it's not time to stop worrying, right? It's never time to stop worrying in the financial markets. That's what we do professionally. So as we look at what's going on in the financial markets, it's still that balance between growth, right? How are all these things that are happening? The Middle East situation, the big beautiful bill, what's going on with tariff? How is that going to balance against inflation? The fact that for the last couple of years, we've experienced price rises at a much faster rate than we've seen in really the last 2 decades, right? How are you dealing with it at home, and how are companies dealing with it in the marketplace? And so what we're going to do today is try and shed some light on that conflict between growth and inflation, which is really at the core of all the conversations we're having really on the investment team. So whether we're talking about corporate earnings, or we're talking about consumption, or we're talking about any of the other metrics, all of these conversations tend to boil down to growth versus inflation, at least in the first half of 2025. Next slide. All right, so I'm going to turn it over and we're going to give you a basic market update, and we're going to try and make this conversational so that everyone is glad they joined us.
Yeah, thanks, Jim. I think there's a couple of interesting points here, and you touched on just how crazy of a year it has been. I mean, Q2 had, started out in a tough way, right? Early days of April, the market declined rapidly with a lot of uncertainty around tariffs. But as it looked like we were making some progress, as it looked like there was some certainty or clarity around how we were going to make that progress, the markets rebounded. And so for the quarter, both equity and fixed income markets had a pretty good run. You can see that U.S. stocks were up almost 11%. International, both on the year but on the quarter as well, still outpaced. But even fixed income assets had a good quarter. I think what's most interesting about this chart, and we talk about it a lot internally, is that this year you've seen diversification really work, right? It has not just been the story of U.S. large cap stocks. International has outperformed. Small caps have underperformed. Fixed income has served as a ballast in a portfolio at the times when equity markets were volatile. And so I think really what we're seeing is that the concept of a globally diversified portfolio has worked this year, and probably for the first time in several. And so I think leaning into that diversification, what we've always known, we're really seeing that play out this year. I mean, sorry, go ahead, Aya.
No, I was just going to mention that, just going back to that chart, you can see that 60-40 ACWI Global Ag over to the right-hand side, 9% year to date. Those are pretty strong numbers. So well-diversified, balanced portfolio, really showcase a good, strong return this year so far.
Yeah.
So what's really the long-term average for that 60-40 portfolio? Where does that come in usually?
I think the long-term average is closer to 4 to 5%. So having a 9% return is really nice to see.
Yeah, actually, it's funny. In a slide later, we do touch on what the long-term average of it is, and so I'm not going to spoil it. We're going to get to it in a minute. But
All right, we'll see
I
who's
think,
right. Maybe we should make everyone guess.
yeah. Well, I know the answer, so I can't. But if you do jump forward one slide, I think this one is just, what an interesting year it's been, right? I mean, if you closed your eyes to Jim's opening points on January 1st and opened them again at the end of June, or frankly, even as of today, the markets are at all-time highs. Everything was great. Everything's rosy. Well, that really wasn't the story on a point-to-point basis. A lot happened in between. And so on the back of, tariff concerns on Liberation Day, we've obviously had a lot of volatility for short periods of time around geopolitical tensions, both in the Middle East and in the Ukraine-Russia negotiations. And so, there's a lot of things that have been going on, and yet the market has continued to grind higher as it sees that so far, on a fundamental basis, the economy has not yet weakened to a degree that I think people expected when we started talking about maybe how prolific some of these policies would be. And so, we certainly are keeping an eye on it. I think we're going to touch on a lot of that going forward here. But it has been interesting to see that the economy so far has remained resilient, and investors can handle kind of bad news as long as they can digest it. What they can't handle is uncertainty. So I think as that uncertainty has become more and more clear, the market's pricing in what they think is coming down the pipe.
Yeah, Doug, and if I could just add something, the one thing that this chart doesn't show, the inverse of that chart, that downward dip and then resurgence, is the volatility index, often referred to as the fear index. And we saw that it was like a roller coaster. I mean, if you were to fall asleep on April 1st and wake up on April 30th, before and after Liberation Day, you almost did a full round trip within that full month. And so we've really seen almost like a year's worth of returns in a very condensed amount of time.
Yeah, absolutely.
So if we jump to the next slide, shifting gears a little bit, let's talk about fixed income. I mean, this is really what's driving everything. And if you take a look at those lines, what you see there on the dark green line, that's the forward curve today, right? What that's telling you is that we're still expecting some rate cuts, right? Not necessarily at the next meeting, but in the rest of the year, we're still looking at perhaps 1 or 2 cuts. But if you look 1 year out, you see a notable difference in the forward curve in 1 year from now. What that's telling you is you're seeing a widening of that 2-year to 10-year spread, and that's a really important indicator. And that bottom right graph, it shows you the expectations for that widening of the 2-year to 10-year spread. And the key takeaway from that is that could be looked at as a catalyst or an inflection point in the business cycle. And so when you see that spread either widen or narrow, that's a shifting in gears of expectations of what's going to be expected in the economy. And what it's basically saying is that you're looking forward and you're seeing higher potential growth and higher potential inflation expectations in the long run, but in the short run, we're looking at future rate cuts. The next one is still uncertain, but we're waiting with a bated breath to see when that happens.
Well, I think,
Gary, I think it's interesting. People always think about higher interest rates as being bad. You're paying more for my mortgage, paying more for my credit cards. But in this case, higher interest rates may actually be sort of the market saying, demand for money is going up. People are going to want more money to invest in businesses. They're going to want more money to build all the manufacturing capacity that we need to buy homes, even if the interest rates are higher. And so that's generally considered a good sign. So Doug, you were going to say something.
Yeah, no, I was just pretty much echoing what you said. I think it's interesting if you look at that difference in the basis points between today and the 1-year forward expectations, you see that the front end is actually declining, right, on expectations that rates are declining, but on the long end is actually expected to go up. And that's saying that, investors are demanding more return for longer dated treasuries, right? They are expecting to get paid, and that's called a term premium. And so, that's interesting to see. There's an expectation there that, maybe there is a little risk as we continue to expand our national balance sheet.
Which is a great segue to the next slide I think we have in here, in that I think there's some concerns over finances when interest rates remain this high, right? And so what you see here is just the government spending over to the left-hand side and the big buckets of government spending there, and then the revenues on the right-hand side. And you can see that we have a deficit that's close to $2 trillion. And deficits aren't new. This is not a new phenomenon for the US government. However, deficits with interest rates being so high is a little bit new. It hasn't occurred in quite some time here. And so you can see over to the left-hand side that the net interest costs are about 14% of total government spending, and that's almost the same as how much we're spending on defense. And that's where some of the concern comes in terms of, you know, what is going on, and perhaps bleeding into the treasury market, and, you know, exactly how those interest rates will perform on the longer end.
Thanks, Aya. If we shift to the next slide, I think this is really interesting, and this also sums up some of the challenges that everyday consumers or investors are feeling in their day-to-day lives. And so what this chart demonstrates, this is the University of Michigan survey, which it demonstrates, it asks people what they expect prices or inflation to be 1 year ahead or 5 to 10 year ahead. And so what you see in the orange line is a lot more volatile because it's a lot more attached to emotions and short-term events. And there's a lot of biases that really have a pronounced effect when it comes to this. There's recency biases, media influence, political biases, demographic skews. All these things influence what people are thinking and feeling and what they think prices are going to be. But then when you have that green line, it factors in some more of those long-term effects. And now survey bias, we often call this the soft data, but it is very relevant because these are some of the things that the Fed is looking at as they think about their forward-looking policy and when they should make that next rate cut. So I think that this is really interesting, and it actually generally reflects the way people are feeling when they go out to shop and they buy things and they spend money, whether on day-to-day purchases or big ticket items, which of course drive that economy.
I think this chart is really interesting to see, like, how stable things were prior to, you know, the pandemic, and how more recently things have just become a lot more volatile in terms of inflation expectations.
Yeah, this is a great segue to jump into the next chart. I think, you know, Gary, you talked about the Fed paying attention to inflation. Well, we talk a lot about the fact that the Fed has a dual mandate. One of those is inflation. The other is a stable labor market. And so, you know, we certainly have seen markets moderate a bit. You know, year to date, new jobs have kind of grown at roughly 100 to 200,000 a month. It's down a little bit. You could kind of draw a trend line on that left chart. That's certainly lower than post-pandemic. But the fact of the matter is we still have positive job growth. And if you look at the unemployment rate, it's stabilized kind of right around that 4 to 4.2 range. It bumps around, you know, a little bit here or there, but we haven't seen, you know, negative kind of job growth. We've seen some signs of moderation that aren't necessarily on here, like job openings coming down. That's typically a sign that businesses are slowing their hiring because they're unsure. They slowed down for a little bit, but then kind of came back. And so, you know, the labor market has continued to remain pretty resilient. It's obviously the Fed's watching it, we're watching it, but so far you have not seen any massive wave of layoffs, any, you know, real shrinkage in the workforce. So it'll be interesting to see, you know, if this moderation just stays and we have a pretty stable, low volatility kind of unemployment rate, or if we start to see some spikes going forward.
Yeah, and I think it's been about a year since the financial media covered the SOM rule was triggered. Everyone was talking about the 3-month average moving 0.5 percentage point off its 12-month low, and here we are, a year later, and nothing's really happened. Just again goes to show the resiliency of the labor market. We just haven't seen that meaningful shift despite some softening.
Yeah, it feels a little Goldilocks to me, though, right? Because, you know, inflation's running not too hot, the labor market's running not too cold, right? And we're kind of balanced. And so the question is, like, how does that play out? Because you won't stay in that equilibrium, you won't stay in that balance forever. And so the question is, what happens next?
And it's always about, is it getting better or is it getting worse?
And here we are with what happens next. So it's a perfect lead in here.
I think one of the things that we want to touch on here is the one big beautiful bill, the tax bill that was recently passed. Here are just some key provisions, and I'm not going to read through this table here, but we tried to take this from both a consumer and a corporate perspective, just because this sort of impacts how markets view the tax impact, both the benefit and the negatives related to this bill. But for the most part, it's been positive for consumers. I mean, we're seeing the SALT deduction get expanded. You have the estate and gift tax exemption there getting more permanent, and the auto loan interest deduction, which is both positive for consumers as well as auto companies, especially here in the United States. I think the other thing that we want to touch on is that 100% R&D expensing and the bonus depreciation, and how that's a real big positive for overall capital spending. And capital spending is really, really important in terms of an economic driver. It's a huge multiplier in the economy. And it can be a big boost to GDP growth. And that's why we have down there at the bottom impact to growth being at least a 0.5% in terms of GDP growth over the next year or so. And we think that perhaps, though, the flip side is inflation risk could start to increase, because as growth increases, there's increased demand, which tends to lead to higher prices. And the other thing I'm just going to mention, sorry, is just that the debt trajectory does get higher, and again goes back to impacting bond markets.
And so Gary, have you read this entire bill? Gary, have you read this whole bill?
Because certainly
the bill's like it's just that's like the intro, that's like the appendix is like this, or not the appendix, the table of contents is like this. So anyone who's listening, I encourage you to talk to your advisor, because there may be things in this bill that can actually impact you from a tax planning perspective. And so make sure you talk to your advisor about how you can use this bill to your advantage to cut down your taxes. There are a lot of provisions in this, and it's very difficult to get through them all. So, sorry, Gary, you're going to add something else.
No, well stated. And I think with everything, you just have to balance the good with the bad, right? There's a lot of potential short-term benefits, but then when we dig deeper and we peel the onions back, we can see that there are some structural issues, and it's really important more now than ever to look at some scenario testing about what could this mean, right? If we do have this prolonged fiscal impact, right? What does it mean to not just the country situation, but your personal situation as well? And if we jump one slide, we can talk about another thing that it could potentially impact, and that's the status of the US dollar. And so this is another thing that made some headlines. It was one of the weakest first half of the year for the US dollar relative to a basket of other major currencies. And so certainly that had an impact. If we remember back to that slide that Doug talked about with the performance of international stocks relative to US, the dollar weakness definitely played a role in that. But some people are questioning, right? Does this have an impact on the US dollar's status as a reserve currency? Is it actually going to make a difference over the long run? And I think what this chart really does a good job of explaining is that the US dollar is still absolutely dominant. It makes up over 85% of all global foreign exchange transactions, and it's about 60% of all global FX reserves, and over half of cross-border payments are done in US dollars. So despite the fact that the US is around 25% of GDP, the US dollar makes up so much more of that. So for those of you that are worried or concerned about the US's status as a reserve currency, I think we're just a long, long ways away from that. But what it does mean is that we still have these kind of questions looming and concerns, whether it's the one big beautiful bill or if it's tariffs, whatever. The takeaway is that currency volatility is something that's just a part of our lives. It's going to impact whether you're spending when you go to a trip to Japan or to Europe, and it's going to certainly impact your portfolio performance. And that's something that we spend a lot of time thinking about and incorporating into our analysis when it comes to capital market assumptions.
Hey Gary, how much was the decline in the dollar? How much role did that play in actually improving the returns on foreign stocks? Because I think that's something that gets overlooked.
Yeah, so I mean, it was over 10% in the first half alone. And that's a pretty significant impact for just a half a year. If you multiply that, that could be a potential 20% difference if the same thing happened on the second half of the year. Although we have seen the dollar stabilize a little bit in the early weeks of the second half, so we're not necessarily calling for that. And remember, the dollar was very, very strong for several years. So a little bit of a pullback normalization is very, very normal.
If you think about it, right, so if you have a diversified portfolio, it's not just that you sort of have diversification across how companies in the US are doing versus Europe versus Asia versus other parts of the world, right? You also have a diversified basket of currencies. Even just on the S&P 500, right? A large percentage of the earnings in the S&P 500 come from foreign currencies. And so when the dollar depreciates, earnings actually go up in dollar terms. And so one of the sort of drivers of the US equity market sort of in the first half of 2025 was really the fact that the dollar depreciated. A lot of people don't sort of think about that, but if you think about how all these different pieces fit together, right, it's very important to sort of be thoughtful in portfolio construction. So there are different ways to get diversification in a portfolio.
Well, here we're at the point where we can see what the, oh, sorry, Jim, I was going to say this is the slide where we do see what the 40 portfolio ended up doing over time. But, I think we like to say this a lot, right? It's time in the market, not timing the market. And you can see on the left of this chart on any 1 year calendar basis from the year 1950 through last year. So for 74 years, the equity markets had, their worst year was down 37, but their best year was up 52%. That's an 89% difference in a best year versus worst year over that period. You can see bonds, typically thought of a very safe haven asset. Best year 33%, worst year 13%. And so that's not even including intra-year volatility, that if you took, peak to trough in any given year, this would be even wider. So in short periods of time, there is a lot of differentiation of returns. But if you look as you go right, either 5-year periods, 10-year periods, or especially 20-year periods, you can see that staying in these markets, you end up with a positive expected return over long periods of time, and that the delta, or the degree in which that positive return is much smaller, right? There's much less differentiation over longer periods of time. And so you can look that over 20-year rolling periods, so any 20-year period in the last 74, the average return of a 60/40 portfolio was 9.4% annualized. So, it's a pretty healthy return if you stay in the markets. So, we've done that in the first half of 2025. So obviously we've had a good start to the year. But the fact of the matter is, staying in markets, your probability of positive returns get higher and higher the longer you stay in them. And so I think this is a great chart. I think it really articulates that point of just staying invested, riding out volatility. A lot can happen in the short term, but over the long term, markets tend to go up.
So am I reading this right, Doug, that there's no 5-year period where the 60/40 portfolio has been negative?
-2 was the worst. Oh, no, excuse me. You're right. I'm sorry. I was looking at bonds. You're absolutely right. Yes. Over any 5-year period in the last 74, yes, the 60/40 portfolio is negative, never been negative.
But that doesn't mean it couldn't happen. But it means if you have a 5-year holding period, even if this year is a really terrible year, right, the 60/40 could be down 20%, which it was in its worst year, probably 2008. If you're willing to hold for 5 years, right, historically your downside's really, we can't find an example where it's negative. Doesn't mean it can't be negative in the future over a 5-year rolling period, but it hasn't been over the last 75 years. So if you believe that the structure of the market, the structure of the economy are likely to be similar, it's very difficult to get too upset about 1 year when you can look at history and see there really hasn't been a 5-year period where it's been negative. I think that's interesting.
Yeah, and I think the other thing that's interesting to your point, you could make an assumption, because this is looking at every 5-year period. If you invested in the worst year for the equity market, the 60/40 portfolio, when it was down 20, your future 5-year return is still positive, right? And so, not that we're saying dump, we obviously think about how you put money to work, but the fact of the matter is, even if you timed it as wrong as you possibly could have in this period, you still would have ended up with a slightly positive return.
It's funny. I once ran into Harry Markowitz, who won the Nobel Prize for portfolio construction, or modern portfolio theory. And I asked him a question about dollar cost averaging, where you put a little bit of money in the market over time to sort of round out or diversify your entry points into the market. And intuitively, it seems like a good idea. But if the market sort of, generally goes up over time, and then mathematically you're better off putting all your money in at once and letting yourself ride the appreciation. But Harry Markowitz, who basically created modern portfolio theory, said to me, well, I dollar cost average. And I said, well, why do you dollar cost average, Harry? And he says, because I want to minimize the maximum likelihood of regret. So he doesn't want to put his money in and have it all fall, and have the market fall the next day. I thought that was an interesting insight into the human behavior, even for a Nobel Prize winning economist in economics. Okay, so where do we go from here, right? So despite the market's rebound, going back to the idea of Goldilocks, right? When you're kind of balancing two things, it's very easy to get knocked off balance. And even though it looks like we're going to have sort of some positive outcomes here on tariffs, or at least less negative than we would expect it, looks like we've reached a deal with the Europeans. It looks like we sort of extended, de-escalated sort of what's going on with what's going on in China. My guess is we'll probably get some sort of a deal or carve-outs with, or meaningful carve-outs on any sort of headline tariffs with Mexico and Canada. There really is a big impact to changing the way that we sort of buy goods and services from abroad, and people abroad buy goods and services from us. And so I don't think it's fair to completely discount the fact that tariffs may have a negative drag on growth. They haven't yet, but it's still new. And so it's something that we're watching very closely. The other thing we're watching very closely, which I was talking about, was the new legislation, the Big Beautiful Bill. Yes, in the short term, right, those tax cuts and some of those accelerated depreciation techniques and all the stuff, the goodies in that bill, it's like having a little bit of a sugar rush. The question is, will the market sort of get scared that over the long run we're spending too much to be sustainable? And as Doug mentioned, there could be two reasons for why interest rates are going up in the long end of the curve. One reason is the good reason, which is what I pointed out, which is maybe growth expectations are going up because people are excited about their investment opportunities and consumption opportunities in the future. The other is a little more negative and something that we in the United States haven't had to think about in a very long time, which is that if we're going to get paid back with dollars that are worth a lot less than they are today, or we're not going to get paid back at all, we're going to demand more premium to hold long-term government debt. Okay, so there's actually a risk premium being baked into the risk-free asset. We used to talk about treasuries as the risk-free asset. May not be the risk-free asset anymore. That's a big change, right? Not calling the end to the risk-free treasury yet, but if that happens because sort of bond investors view sort of the federal government as irresponsible with their spending, that could lead to some problems, okay? And as we look at interest rates, we do expect the Fed's going to hold. They're going to wait till we get through some of this uncertainty, and then it's very likely that towards the end of the year, we'll get 1 or 2 cuts. Okay, there's a lot of noise out there. There's a lot of pressure on Powell and the Fed to cut interest rates, but they're very data dependent. I don't think they're being political. I think they're following the data, and they're nervous because they're not sure what tariffs are going to do. As we look forward, we think that volatility is likely to stay elevated. So we've had a really interesting run here this summer where equities keep grinding higher, keep reaching new heights, but we don't think that's necessarily sustainable with all the different things going on. We think that short-term government bonds probably provide some opportunity for near-term appreciation as the Fed gets closer to its cutting. We also think there's some very interesting opportunities here to add additional diversification to the portfolio, whether that's through option-like strategies, private assets, real estate, or commodities. We saw the benefit of being diversified this year. We think the benefits of diversification are going to continue, right? Another way to say that we think the benefits of diversification continue is to say we don't think that the entire equity market return is going to come from 7 stocks on a go-forward basis. And that's what we saw with the Mag 7 and before that with the FANGs. We're going to see some broadening out. We're going to see return to other places of the market. And so it's a good time to be diversified. So I think with that, I think we have a couple of questions, Tom. Do you want to sort of read those questions that have come in during our broadcast?
Absolutely. Let me pull them up here. So the first one, what is the impact of U.S. tariffs on investment portfolios going forward?
Aya, do you want to grab that?
Sure. So I think one of the things that we're thinking about in terms of the impact of tariffs is really just when are they really going to come through? I think a lot of corporations have taken a little bit of the initial bite regarding tariffs, but eventually these all come through to the consumer. And so as we go through the next 6 to 12 months, we're going to continue to see parts of the price increases really come through as the supply chains, figure out where those tariffs will be placed.
I think another one of the interesting things. Sorry.
Gary, there's something I heard very interesting today. John Cochran, who's a professor at Stanford, University of Chicago, came out and he said, look, if nominal income stay flat, right? So if you make $100,000 a year and you only make $100,000 a year, right? And now it costs more to buy the BMW because there's a 15% tariff on BMW. That means the price of something else has to fall, right? And that's where you get in conversations like AI, productivity, et cetera. And so there's an argument out there that's interesting and it's been put forward by very serious academics and thinkers about the macroeconomy that tariffs may be zero sum, which may not actually increase sort of prices in aggregate, increase prices for some assets, but because income is flat, right, other assets have to decline or other goods have to decline in price. And it's a really interesting take on how tariffs may impact the economy. We'll see, right? It will definitely make the economy less efficient, but I think that that's an interesting alternative take to sort of what's in the mainstream narrative out there about tariffs increasing prices. Gary, you were going to add something?
Sure. I was just going to add the fact that, a lot of the tariffs are being questioned in the courts, and it's going to take some time to work its way through that system. We could go all the way to next summer. And while that happens, companies are going to delay big CapEx expenditures if they're not going to shift their entire global supply lines when they think that there's a possibility that some of those tariffs could get potentially reversed. So we are kind of in a wait and see mode. And in the meantime, that decrease in CapEx could have an impact on global GDP. There also could be a refunding of some of those tariffs already paid, which is actually another factor to be considered. So there is going to be just another layer of uncertainty that's going to have multiple impacts to both consumers as well as, global shippers.
Yeah, and I think, if just looking through the not the total gray lens, but I think if tariffs prove out, I think they're less than we originally were telegraphed. I think they're probably a little bit more digestible. But if it does help balance that deficit in some way, that can be a positive. That can help us get back to kind of hopefully growing through some of the accumulated deficit we have, and maybe putting our balance sheet in a better way over time. To Jim's point, there's a lot of talks from economists about the effect of AI on productivity and the fact that maybe that does help us over long term kind of get ourselves out of the pile of debt we have.
we could do a webinar without mentioning AI. I hate when people talk about it because it sounds so nebulous and futuristic. But the reality is it's here. You're already starting to see companies sort of drive cost improvements with AI. We're really in version 1.0. I mean, this is like when you go on the web and everything would be sort of like that teal and pink color, right? And it would be block letters and it would be slow and you wait for it to load, right? We're at the very, very beginning of AI. And I don't even know that the winners of AI yet have emerged. But I think 5 years from now, we're talking about AI, we're in a very different place. And I think we're going to see some meaningful impacts. Maybe one more question, Tom?
Yeah, sure. Markets appear to be overvalued and overpriced. Besides keeping cash in a high yield money market fund, where should we invest?
Gary, why don't you start that one and we'll hand it to Doug.
Sure. Yeah, I mean, it's true that U.S. equity markets are still at their historical high end, but that doesn't mean there aren't pockets of opportunities everywhere you look. We pointed out and talked about international earlier. I think it's really important to maintain global diversification. You can look at all sorts of alternatives, whether in the public or private form. Things like infrastructure continue to be really interesting. Real estate has actually been somewhat depressed because of higher interest rates. There's some good opportunities there. There's things that are structured notes or other hedged equity type investments that can actually provide participation to equities, but also provides a little bit of buffer on the downside. The important thing is, of course, not getting over your skis and looking for a globally diversified portfolio that's thoughtful, that's diversified, and has elements of liquidity and risk management incorporated. And most importantly, all of these things should be easily understandable and explained to you by your financial advisor. So we can't make a blanket recommendation that's perfect for everyone. It's all about what's best for you, what's aligned with your objectives, your risk tolerance, and of course, all your other unique considerations.
Yeah, Gary, I think I don't have much to add in the way of, asset classes that we think are attractive, but I think, when people say markets are at all-time high or it looks expensive, right? It's typically a blanket statement. It's very broad brushed. And yes, I think we agree that indices and certainly do appear to be at the higher end of their valuation ranges historically. We know that the concentration, especially in the S&P 500, which is kind of the bellwether that we look at for an equity index, the concentration is driven by those high valuation stocks, which thus drives the entire index up. But to your point, going back to Jim's closing comments on diversification, we don't just buy the market, right? We do make thoughtful decisions about where to place capital. There are exposures in our portfolios, not just to or at weight to those those more expensive companies. So I think there's opportunities underlying, the broad statement that markets are expensive. Not everything's expensive. I also think, if you could make the same argument on the fixed income side. We do see, corporate credits their spreads are tight, which means you're not getting paid as much for the risk. But that just means the market's telling you that balance sheets are really good. Corporations are in a good place. You're not commanding as much of a spread or as much of an additional return to invest in those. And so that doesn't mean we put all the money in there, but it's certainly, as Jim pointed out, we do think that, shorter term treasuries or investment grade corporates are a great place to earn some additional income. So there's always something to do, even when markets, optically appear to be at, tippity tops.
Last thought on that, if you look at the equal weight S&P 500, where each stock is 1/500th of the index versus sort of the market weight, which is generally what's reported, valuation looks much more attractive, right? So the broad market looks much more attractive than sort of the bellwether stocks that you hear about on the news every night. And the second thought is, if you go back to that slide we looked at, which is there really hasn't been a 5-year period where the 60/40 has had negative return. And so even if stocks are expensive today, even if next year is going to be a bad year, and we don't know that, we don't know if it's going to be a good year or a bad year, or we don't know how it's going to turn out, you historically at least, and there's no reason to believe this is going to be different in the future, have been better off being invested than sitting in cash, especially if you think there's going to be inflation. Because if there's going to be inflation, right, that money market yields can get eaten up by inflation, and you're actually going to feel like you're in a safe asset, but every year inflation is going to sort of eat away 1 to 2% of that cash that's sitting there, and you're going to wake up and you're going to have the same amount of money, but you're going to have a lot less purchasing power. So with that, I appreciate everyone joining us. Please join us again for our next webinar. If you have questions about anything in this podcast, make sure that you ask your advisors. Thank you again for joining us. Thank you again for trusting us with your money, and we look forward to talking to you again soon.